Okay, we are moving into our final section on economics, or in this case, personal finance. So we're talking about banks and banking. A lot of this we've discussed. So we're going to go ahead and get started. I'll give you 1 minute. Let me see why this isn't working properly. To start writing, and then I will begin explaining. Okay, so the idea of banking has existed as long as there has been trade among human beings. So if somebody traded some grain for a piece of livestock, so like a bushel of wheat for one pig, that indicates that there was a transaction and people had to keep track of that. And that's where banking comes from. Now, when we talk about banking nowadays, that's really more, I'm not going to say modern invention, but it is something in the last, say, 500-600 years that has really kind of taken off. Many kind of going back to the Renaissance in Europe and the way that we look at banking, or the late Middle Ages, and where you had families like the Medici and the Borgia who were massively wealthy on their own, and they figured that instead of actually buying positions of power, like trying to be kings and queens or other types of heads of state, they found the power was that they could actually take their personal wealth and lend it to kings and queens. And then when they needed either a favor or when they needed to make even more money, then they would call in those loans. And it kind of set a precedent of governments are always one of the best things to lend money to, in that typically they're going to be around in some shape or form and they have to pay their debts. Our modern day banking, in terms of like present day, was heavily influenced by the Great Depression, by making sure that banks can't just do whatever they want, that the federal government has a stronger hand in monitoring them and making sure that they have the currency that they need, as well as making sure that banks don't shut down. But that doesn't mean that it's been smooth running since the Great Depression. Depending on different types of governments, different politicians, Democrats and Republicans, at sometimes they lessen the restrictions on banking and investing, and that typically leads to big problems within our economy. In the short term, we're talking about savings and loan scandals, or S&L scandals of the 1980s. There was the dot-com bubble bursting in the late 90s when a heavy investment in online shopping and online companies kind of just exploded because there was far too many. And then you have what's happened early in your lifetime, which is the Great Recession, when we had a housing collapse in this country, and it nearly shut banks down worldwide. All right, again, 1 minute. If I can get the timer up. And I will begin explaining. I will go a little slower since we have a little more here, give you a little more time. But the main idea that we're looking at with the banking system here in the United States is that it serves two functions primarily, which is a place for you to store your money, and it's also a place to lend you money. And so all banks do some iteration of that, whether they do checking and savings, or they just do checking, or they just do savings. But that is the idea of the banking system in the United States. So you have your checking account, which is the money that you're paid for whatever services that you perform for your job. That's where you can keep that money and then be able to access it whenever you need. In the old days, that was you'd have to go up and you'd have to talk to a teller to get cash out, or you just write somebody a check. Now we have debit cards, you have online transfers that make things far easier to access your money. Almost all banks offer savings account, which is to store your money long term. So this isn't money that you access on a daily basis. This would be money you access maybe once a year or every 5 to 10 years. And the idea there is that a basic savings account, you put the money in and you get a small return interest rate, meaning that you put the money in and you might get, say, like 4% annually. So you put $1,000 in, at the end of the year you get $400 added to that amount. Then the next year you get 4%. As long as you didn't touch it, you get 4% on top of that, which will be you'll get a little more than $400, and that just keeps rolling and rolling and rolling. And the more money that you put in to those accounts, the more money you're going to get back. That's the general idea of a savings account and all different types of it. And then you have your money market accounts, which allow you to earn more on your savings, but there are more restrictions on how you can get that money out. The normal savings account, you can transfer it back and forth. A money market account, though, might be tied up in stocks or bonds, depending on what your bank has done with the money that you've saved. So they tend to not want you to pull that money out at a moment's notice. So there might be a higher penalty. You might have to pay immediate taxes on money that you withdraw, or they might have to give you a period of time that you can't touch that money. And we're going to get into that on the last slide too. And then you have what you normally see is what we call commercial banks. So they offer checking and savings and lending. You have specialty banks like savings and loans that used to be all over the place. Now there's just maybe a handful across the country because of poor practices by the savings and loan industry. But their main thing is to help you save up and make a down payment on a home. You also have just straight up savings banks. A lot of these are online, and they offer a higher interest rate on your savings, but they have less protections by the federal government. And then the other more common one that you run into is a credit union. And this is a bank that does the same thing as a commercial bank. But instead of being run by a banking corporation, it's run by the people who actually put money into it. So the more people that are in a credit union, the more money it has to operate. And their primary goal is to offer low interest loans to buy houses. All right, 1 minute, and then I'll go over this. All right, the timer on the screen's off, but I'm going to go ahead and get started. Quick backstory is that when the United States was founded, when our federal government was founded, we had a national bank that handled everything, that did currency, that established state branches, and everything ran through that. During the presidency of Andrew Jackson, he finally destroyed the national bank, setting up state banks and private banks. And this created economic instability for the United States pretty much all the way up through the early 1900s, which is why in 1913, the federal government established what's called the Federal Reserve. And this is sort of a balance between the two, is that you have a federal organization that monitors banks, making sure that they have what they need and that they're not doing anything bad for their customers. And there's going to be more things that happen after the Great Depression, if you recall from your U.S. history. So the Federal Reserve splits the United States into 12 banking districts, and a Federal Reserve Bank is there to lend and monitor money to private banks. But no private citizen, me nor you, ever interacts with a Federal Reserve Bank. You can't get an account with the Federal Reserve Bank. You can't go to them and ask them for money. They are there. They're the bank of banks, is sort of the way to think of that. The Federal Reserve is also there to buy and sell government bonds. They're the bank of the United States government. So if the United States government needs loans from individual people, the Federal Reserve is the one that sells those government bonds. And then if they need to, they buy them back, and then you get the money and the interest from that. And the Federal Reserve is there to lend money to private and state banks with interest. So they still function like a normal bank, but they're also, if your local bank needs a little more money to operate, they can take out a loan with the Federal Reserve. Who runs the Federal Reserve? Well, the Federal Reserve is run by a board of governors, and every single one of those is appointed by the president, and they run those 12 different districts. And they make those decisions of whether to buy or sell bonds. They are the ultimate deciders if that district bank is going to actually lend money out. And the Federal Reserve overall sets interest rates for lending in the United States. This has been a big deal over the last several months, last couple of years. As inflation has gone up, the Federal Reserve has raised interest rates to try and combat that and try to keep prices at a reasonable level for consumers. So over all of this is what we call the Federal Reserve Chairman. Again, that's a person appointed by the president, and they serve for terms of about 10 years. And that's to make sure that, if a president kind of gets somebody appointed but then doesn't like them, they can't just change them out, because we need stability in our economy. And that is where we're going to leave it at today.